Imagine looking at a stock that has just plunged dramatically from its all-time highs. I mean, we are talking about a massive structural drop here.
Oh, yeah. A total nosedive.
Right. But then you look at the underlying business,
Yeah.
and it is pumping out like oceans of undeniable cash flow.
Which is always the weirdest disconnect.
It really is. It leaves you staring at your screen with one massive question.
Yeah.
Are you looking at the ultimate discount, like a screaming strong buy that the rest of the market has somehow just mispriced?
Or are the flashing technical signals warning you that you're about to catch a falling knife?
Exactly. Are you about to be left holding a massive loss?
It's honestly the ultimate psychological test for any investor. Because you have fundamental data screaming that the company is a powerhouse, right?
Yeah.
But then the actual market mechanics, the algorithms, the price action, the institutional flows, they're telling you a completely different, much darker story.
And we are jumping straight into that exact dilemma today. Welcome to the deep dive. Today, we're looking at AppLovin Corporation, ticker symbol APP. As of today, April 16th, 2026, we have a literal mountain of conflicting sources to go through.
We really do. I mean, we've got real-time market data, technical indicator readouts, massive insider order flows, and some, frankly, wildly optimistic analyst ratings.
Yeah, it's a lot to unpack. So our mission for you today is to sort through all this noise and figure out if this highly volatile tech player is a hidden gem or just a classic, carefully disguised value trap.
Which is a tough call.
Very tough. And hey, before we really get under the hood here, make sure to like this video and subscribe to our YouTube channel. And it is absolutely compulsory that you leave us a comment with your feedback. We want to know where you stand on today's debate. I mean, are you buying the dip or running for the hills?
Definitely let us know. But just to set the ground rules for you as we dive into this, everything we discuss today is a natural, objective debate of the provided data.
Right, for educational purposes.
Right. Exactly. We're analyzing market mechanics and company financials, but this is absolutely not financial advice.
Never is. So think about AppLovin this way. Is this stock a high-performance sports car that just went on a massive sale? Or does it have a blown transmission that the dealership is desperately trying to hide?
I like that analogy.
Thanks. To figure that out, we have to look past the stock price for a minute and look at the core financials. What kind of machine are we actually evaluating here?
Well, let's contextualize the scale first. AppLovin currently has a market cap pushing $156.7 billion.
Huge.
Yeah, massive. The stock is trading around 464.63 right now, and it did just have a nice little bounce up about 7.18% recently.
But you really can't look at that 464 price in a vacuum, right?
No, absolutely not. You have to look at the massive 52-week range. Over the past year, this stock has been as low as $222, and it peaked at a towering $745.61.
Wow. I mean, a $500 swing in a single year for a company worth over $150 billion. That is the kind of volatility you'd usually expect from a tiny penny stock, not an enterprise of this size.
Yeah, it's wild price action. But when you look at the actual income statement, the narrative gets really confusing because the business itself looks like an absolute juggernaut.
The raw profitability is just staggering. I was looking at the trailing 12 months at the TTM revenue is sitting between 5.48 and 5.81 billion.
Right, and out of that revenue, their net income, the actual profit after all the bills are paid, is at an impressive $3.43 billion.
With an EPS of 10.04.
Exactly. And the cash flow is equally crazy. For the full year of 2025, they generated $3.95 billion in free cash flow.
Which is huge.
It is. They're sitting on roughly $2.49 billion in pure cash right now.
Against about $3.54 billion in debt, right?
Yeah.
Total assets of $7.26 billion versus total liabilities of $5.12 billion.
Yeah, that's the balance sheet breakdown.
Wait, let's slow down and look at those margins for a second.
Yeah.
Generating $3.43 billion in net income on roughly $5.8 billion in revenue. That means they're operating with gross margins around 86%.
86%, yes.
Plus, I saw a metric in the research that honestly just stopped me in my tracks. The return on equity, or ROE, is sitting at a staggering 203 to 212%. I mean, how is that physically possible?
It sounds absurd. Yeah.
Does that just mean they are hyper-efficient with every dollar of capital, or is there, like, some accounting magic happening behind the scenes?
Well, it's actually a combination of two things. It's brilliant software economics mixed with strategic mathematical leverage.
Okay, break that down for me. How does that ROE actually work here?
So ROE measures a company's net income against the shareholders' equity, which is essentially the company's assets minus its debt. Because AppLovin is a software company, once their platform is built, it costs almost nothing to scale it.
Right. You build the code once and distribute it a billion times.
Exactly. Serving an ad to 1 million people costs roughly the same as serving it to 10 million. That's what drives those crazy 86% gross margins.
But that still doesn't explain a 200% return on the equity. I mean, that's off the charts.
That is where the debt comes in. Remember, they are carrying about $3.54 billion in debt. In the mathematical formula for ROE, debt reduces the total shareholders' equity on the balance sheet.
Oh, I see.
Yeah, so if the denominator of that equation, the equity, shrinks because of the leverage they've taken on, the overall percentage artificially spikes.
Got it. So, yes, the operational efficiency is top tier, but that 200% figure is also heavily fueled by how they structure their balance sheet.
Exactly. It's a mix of a highly profitable software model and some very clever financial engineering.
And all of this underlying health culminates in a metric that the bulls are constantly pointing to. AppLovin has a perfect Piotrowski score of 9.
Yeah, the bull case really leans heavily on that. The Piotrowski F-score is essentially a comprehensive medical physical for a company's balance sheet.
Right.
It's a 9-point system that looks at profitability, leverage, liquidity, and operating efficiency. Scoring a 9 out of 9 means the company passed every single test with flying colors.
So their blood pressure is perfect, their cholesterol is low, and they crush the stress test.
Exactly. It indicates they are generating positive net income, their operating cash flow is strong, they are improving their margins, and they're successfully managing their debt. It is like the ultimate fundamental green light.
Okay, so here's my question. If the physical is perfect, why is the patient collapsing?
That's the million-dollar question.
Right. I mean, why is the stock currently wrestling with gravity around $464, which is hundreds of dollars below its $745 peak? If the engine is flawless, why is the car slowing down so drastically?
To answer that, we really have to pivot away from the backward-looking balance sheet because the financials, they tell us what the company did.
Right. Past tense.
Exactly. To figure out what the stock is doing right now, we have to look at market sentiment, technical indicators, and, well, who is actually hitting the sell button?
Right.
Let's look at the long-term moving averages first, specifically the 200-day simple moving average.
Yeah, the technicals are painting a pretty grim picture. The 200-day SMA is currently sitting way up at 517.26. With the stock trading around 464, it is significantly below that long-term trend line.
And we need to explain why that specific line matters so much.
Go for it.
Institutional algorithms and massive fund managers monitor that 200-day moving average like a heartbeat. It represents the long-term trend of the stock. When a stock breaks below that line and stays below it, risk management algorithms automatically start trimming positions.
So it triggers a structural strong sell signal.
Yes, exactly. It tells the broader market that the long-term buyers have stepped back and the momentum has fundamentally shifted. And the 50-day SMA isn't helping much either, sitting at 431.81. It's acting as a neutral or sell pivot.
But it isn't just faceless computer algorithms hitting the sell button here.
Yeah.
The human element is what genuinely startled me in our research.
Oh, the insider dumping.
Yes, we are seeing massive red flags in March 2026. Insiders dumped over $160 million worth of shares in just the last 90 days.
That's a lot of stock.
It is. Specifically, Director Eduardo Vivas sold roughly $74 million. That's 164,000 shares just a month ago. So if the chef won't eat his own cooking, why should we?
It's a fair point.
Seeing insiders dump $160 million makes me want to run for the exit. Is that a definitive red flag, or are these just executives cashing in their chips?
Well, context is crucial with insider selling. Executives sell stock for plenty of mundane reasons, right? Tax obligations, buying real estate, or just basic portfolio diversification.
Sure.
But the sheer volume matters. Dumping $160 million in 90 days carries immense psychological weight. It signals a severe lack of near-term confidence from leadership. They're looking at the same landscape we are, and they decided that holding liquid cash was safer than holding their own equity right now.
Wow. And it correlates perfectly with those strong sell signals on the moving averages. Plus, they might be looking at their own valuation and realizing things got a bit too hot.
Oh, absolutely.
Platforms like Alpha Spread and Simply Walson are claiming the stock is actually overvalued by 15 to 29%. They estimate the intrinsic value is somewhere closer to the $276 to $465 range.
Which means at 464, it's priced at absolute perfection.
Exactly. And AppLovin's PE ratio is towering right now. It's sitting at 33.19x to 48.3x.
And just for context, the software industry average is roughly 30x.
Right.
So when you pay a PE of 48, You are paying $48 for every $1 of the company's current earnings. That is a massive premium. You only pay that kind of multiple if you believe unprecedented hypergrowth is an absolute certainty.
Right? You aren't paying for what the company is today. You are paying for what you hope it will be in 5 years. And if they stumble even slightly, that multiple is going to collapse.
Spot on.
So we have scary long-term moving averages, executives bailing out to the tune of 160 million, and a valuation that looks incredibly stretched. But Wall Street analysts are basically ignoring all of this.
They really are. They're surprisingly optimistic.
The consensus rating remains strong buy to moderate buy. Their average price target is 641.81. That implies an upside of almost 48% from where it is today. And the high target is 860. Even the lowest target is 340. What on earth are the analysts seeing that the insiders are missing?
It all comes down to the AI catalyst. Specifically, AppLovin's AI-driven advertising engine called AXON 2.0. In digital advertising, the company with the best predictive algorithm wins.
How does AXON 2.0 actually work? Like, what makes it so special compared to any other ad network?
It's designed to predict user behavior by crunching massive data sets in milliseconds. When you open an app, AXON 2.0 evaluates your past behavior, your demographics, and your engagement to figure out exactly what ad will make you click right in that specific moment. And it reportedly outperforms software peers in ad optimization.
And now they're expanding it into e-commerce, right?
Exactly. AI is the magic word that gets analysts to justify those multiple expansions. The long-term bullish outlook hinges entirely on this engine.
And it seems like that AI narrative is giving the stock at least some short-term momentum. It's not all doom and gloom technically.
No, there are some bright spots.
The Relative Strength Index, the RSI, is currently neutral between 42.65 and 59.07, which shows it's stabilizing. And the ATD is 7.47, which is a bullish signal.
Yeah, the MACD moving average convergence divergence is a fantastic tool. A positive 7.47 means that the short-term momentum is turning positive. The car is speeding up right now, pulling away from those recent lows.
We're also seeing reports of institutional scale buying volume coming in at the 433 to 477 range.
Right.
So big money is spotting an opportunity. But I have to push back on this overall bullish thesis.
Go for it.
So Wall Street thinks the AI narrative of AXON 2.0 outweighs the insider selling, but isn't relying on a perfect Piotrowski score kind of a trap. I mean, that score is completely backward-looking. It tells us they were incredibly healthy. It doesn't tell us they will be, especially the tech landscape shifts.
I agree completely. That is the core vulnerability of fundamental analysis here.
Right.
Metrics like the Piotrowski score only tell you about the road you just traveled.
Right.
AI creates a beautifully compelling story for the analyst to sell for the road ahead. But if you look closely at the actual volume data while institutions are buying, that volume is fading slightly after the recent bounces.
Ah, so there's hesitation.
Exactly. Institutions are nibbling at the current price, but they aren't taking massive, high-conviction bites.
So we have an intense collision happening right in front of us. We have bearish insider behavior and scary moving averages crashing head-on into bullish AI potential and pristine historical financials.
It's a real battleground.
It is. Which brings us to the ultimate debate for anyone looking at this. Is this an undervalued buying opportunity or a carefully disguised trap where retail traders are going to be left holding the bag?
To navigate that, you have to look at the key levels, the battleground. Right now, current resistance, the ceiling it's banging its head against, is $447 to $465. We are right at the top of that resistance right now.
And what happens if it breaks through?
If the stock breaks above 465 with volume, it could recover quickly to the 520 range, which gets it back above that crucial 200-day moving average.
Okay, but what if it gets rejected here?
Then you see short-term weakness. It will likely drop to retest liquidity pockets around 420. And if that fails, we are looking at a drop down to the major support and demand zone between 365 and 395.
This is exactly where you, the listener, need to be extremely careful. It is so easy to pull up a chart, see a massive drop from a 52-week high of 745, look at the current 464 price, and instantly assume it's on sale without understanding the vulnerabilities.
Yeah, that's why retail gets trapped. It's anchoring bias. They anchor to the 745 peak and assume that's the deserved price. But the market doesn't run clearance sales.
How do we distinguish between a temporary hurdle and a structural ceiling then? Because the downside risks here seem pretty severe.
They are. The AI moat everyone is so hyped about is honestly pretty opaque, and it's heavily vulnerable to rising ad blockers and new privacy regulations from companies like Apple and Google. And AI is only as good as the data it's allowed to scrape.
Plus, you have broader geopolitical volatility dragging down overall tech sentiment, like the conflicts in the Middle East. High multiple stocks are the first to get liquidated when fear rises.
Exactly. It's the difference between the short-term view navigating those vol resistance bands and the long-term view, which is basically a bet on whether AXON 2.0 can outpace regulatory risks.
Let's bring this all together and outline the ultimate scenarios based on all these sources. Best case scenario, AXON 2.0 drives massive e-commerce expansion, pushes past that 465 resistance, and marches steadily toward that 641 analyst target.
And the worst-case scenario. Privacy regulations choke the AI moat, the insider fears are validated, the stock gets rejected, and it bleeds down to test that 365 support, bringing its valuation crashing back down to reality.
It's a lot to weigh. And just a brief natural reminder before we go, our debate today is an exploration of the data. It is not financial advice.
Absolutely not. But I do want to leave you with one final lingering question to ponder as you look at all this.
Let's hear it.
If AppLovin's AI engine is truly revolutionary enough to justify those 86% gross margins and outsmart the competition for years to come, why did its own directors feel the urgent need to cash out tens of millions of dollars just weeks ago? What do the insiders see coming that the AI narrative hasn't priced in yet?
Wow. That is the ultimate question. What are they running from? Well, thank you for joining us on this deep dive. Remember to subscribe, leave your thoughts in the comments, and keep questioning the data until our next deep dive.